Jack Ma is the richest man in China, which means he has more to lose than almost anyone on Earth. On October 24th, 2020, he stood up at a finance conference in Shanghai and gave a speech. 20 minutes, no notes. He said Chinese banks had a pawnshop mentality. He said the global banking accords were an old people's club. He said China's financial system wasn't a real system yet. The audience applauded. 2 days later, regulators summoned him. 2 days after that, the largest IPO in the history of the world was dead. $34.5 billion. Gone. And then Jack Ma disappeared. Not fired, not arrested, not publicly. He just vanished. For nearly 3 months, the most famous face in Chinese business gave no interviews, appeared at no events, posted nothing. The speech wasn't a mistake. That's what makes this story uncomfortable. The speech was the clearest thing he ever said, and it cost him everything. To understand how a 20-minute speech could destroy a $34 billion empire, you have to go back 30 years. In 1995, Jack Ma is on a trip to Seattle, and a friend shows him something called the Internet. He types the word beer into a search engine. He sees American brands, German brands, Australian brands. He searches China. There's nothing. Not one Chinese website. He is 31 years old. He has failed China's college entrance examinations twice. He applied to 30 jobs after college. KFC hired 24 out of 25 applicants in Hangzhou. He was the one they turned down. He has no technical background. He cannot write a single line of code, but he sees what the gap means. In 1999, Jack Ma gathers 18 friends in his apartment in Hangzhou, an English teacher, a librarian, a translator, and he tells them they're not competing with Chinese companies. They're competing with the Americans. The company he names Alibaba is built on a simple insight. Small Chinese manufacturers need a way to reach buyers outside China without going through state-owned trading companies or the banks that won't lend to them. The company nearly dies twice. The dot-com crash empties the internet. SARS closes China. But Alibaba survives. It outlasts eBay in China. eBay had been the dominant platform in Chinese e-commerce. By 2006, it had surrendered the market entirely, and in September 2014, Alibaba lists on the New York Stock Exchange. The IPO raises $25 billion, the largest in American history at the time. The stock opens its first day of trading at $92 a share, up from the $68 IPO price. Jack Ma's net worth crosses $24 billion overnight. He is, briefly, the wealthiest person in Asia and the most recognizable face of the idea that China was open for business. But the e-commerce platform was not the most important thing Alibaba built. E-commerce only works if strangers trust each other enough to pay. And in China in 2004, nobody trusted strangers enough to pay. Banks wouldn't extend credit to small sellers. The court system wouldn't protect buyers from fraud. So Alibaba built its own trust layer. Alipay launched in 2004 as an escrow service. The buyer pays into Alipay, the seller ships the goods. Alipay releases the funds when the buyer confirms delivery. It solves the trust problem completely, and then it expands. Utility bills, taxis, restaurants, hospitals, government services, street food stalls. By January 2019, Alipay has 1 billion global users, a single Chinese payment app used by more people than live in Europe and North America combined. And then, Alipay does something more interesting than payments. It launches a money market fund called Yue Bao, leftover treasure, that lets users park idle cash and earn interest on it overnight. By 2018, Yue Bao has grown into the largest money market fund in the world. Not in China, the world. Here is where the first crack appears. In 2011, Jack Ma quietly transfers Alipay's ownership out of Alibaba's corporate structure into a separate entity that he personally controls. Without the formal approval of Yahoo and SoftBank, Alibaba's two largest foreign shareholders. It violates agreements. It ignites an international dispute. Ma says regulators required it. Chinese law would have prevented a foreign invested entity from operating a payment license. The regulators later confirmed the transfer was necessary, but the episode reveals something important about Jack Ma. When the rules conflict with the strategy, he rewrites the rules, and so far, Beijing has let him. By 2020, Ant Group, the financial holding company built around Alipay, is filing for a simultaneous dual listing. Target raise, $34.5 billion. Implied valuation, $316 billion. $316 billion. Take a moment with that number. Goldman Sachs, the bank that has defined global high finance for a century, was worth about $65 billion at the time. JP Morgan, the largest bank in the United States, had a market cap of roughly $300 billion. Ant Group, at its IPO valuation, would have been worth more than JP Morgan, and Ant Group was not a bank. This was precisely the point. Ant Group had no branches, no tellers, no deposit insurance, no capital reserves in the sense that regulators require. What it had was data, the complete transaction history of a billion people, and a risk model fast enough to underwrite a loan in 3 minutes that a state bank would take 3 weeks to approve. It extended credit to small businesses the formal banking system had written off as unscorable. It had built entirely outside the state financial system, something that functioned better than the state financial system. And the party had watched all of this happen. The regulators had reviewed the IPO structure. The roadshow was underway across New York, London, and Hong Kong. Institutional fund managers were placing orders. Retail investors in Hong Kong had oversubscribed their allocation by 870 times. In Shanghai, the oversubscription ratio was 284 times. The demand was staggering. Investors had to tie up billions in escrow just to enter the lottery for a share allocation. The listing was set for November 5th, 2020. Simultaneous openings, Hong Kong and Shanghai. But Ant Group carried a liability that did not appear in its prospectus. Not a financial liability, a political one. A private company that controlled the financial lives of 1 billion Chinese citizens had grown, in the party's view, to a scale that made it not just a business, but a systemic risk. Not to the economy, but to the party's monopoly on the economy. The IPO had been approved, the speech had not been. November 5th, 2020. The Hong Kong Stock Exchange and the Shanghai Star Market were configured and ready. Allocation notices had gone out. Trading systems were set. The banks had their underwriting fees locked in. Jack Ma held roughly 8.8% of Ant Group, which at the IPO valuation would have placed his personal stake at approximately $27 billion on top of his existing wealth. In a single morning, he would have become one of the wealthiest human beings in recorded history. The institutional demand was historic. Fund managers who had spent decades investing in financial technology believed Ant Group represented something genuinely new, a proof of concept that financial services could be delivered at 10 times the scale with a fraction of the infrastructure. This was not speculative froth. These were serious people making serious bets. And then, in the middle of the night before trading day, the Shanghai Stock Exchange published a notice. 4 paragraphs. Ant Group's IPO was suspended, effective immediately, pending clarification of regulatory requirements for online micro-lending businesses. No press conference, no further explanation, no prior indication this was coming. By the time Asian markets opened, Ant Group shares simply did not exist as a tradable asset. Investors who had locked up billions in subscription deposits began receiving refunds. Bankers who had spent 18 months on the deal were told the deal was over. Ant Group's valuation fell in a single regulatory notice published in the night from $316 billion to nothing. The suspension cited regulatory changes, but the regulatory changes had been made, in effect, 11 days earlier, in a 20-minute speech on the Bund. Go back to October 24th of 2020, the Bund Finance Summit, Shanghai. Jack Ma takes the stage. He speaks for 20 minutes without notes. He is at the height of his confidence, the most famous private businessman in China, days away from the moment that would have defined his legacy. He has navigated the Communist Party's requirements for 2 decades, the variable interest entity structures designed to route foreign investment around ownership rules, the data sharing agreements, the partnership governance designed to keep him in control without technically violating regulations. He has turned every constraint into an architecture. He is comfortable. He says that China's banks have a pawnshop mentality, that they only lend to companies with collateral, which means only to the already wealthy. He says that innovation cannot be governed by a pawnshop. He says the Basel III Accords, the global banking standards written after the 2008 financial crisis, are an old people's club, designed by the developed world to protect itself from the developing world. He says there is no systemic financial risk in China because China has no real financial system yet. He says China must not let yesterday's methods regulate tomorrow's future. The audience applauds. A senior Chinese regulator is sitting in the front row. On November 2nd, 9 days later, 4 of China's most powerful financial regulators summoned Jack Ma and Ant Group's chief executives to a closed-door meeting. The People's Bank of China, the China Banking and Insurance Regulatory Commission, the China Securities Regulatory Commission, and the State Administration of Foreign Exchange. The readout afterward is sparse. Regulatory changes affecting online microlenders are under consideration. On November 3rd, the Shanghai Stock Exchange issues its 4-paragraph notice. After November 5th, Jack Ma says nothing. No statement, no social media post. His last public appearance before the suspension was a children's programming competition on October 31st, 4 days before listing day. Then silence. For 93 days, the most famous face in Chinese business gave no interviews, appeared at no public events, made no phone calls to journalists. His Weibo account went quiet. His face disappeared from billboards that had featured it for years. He reappeared on January 20th, 2021, in a 2-minute video at a Rural Teacher Awards ceremony. He looked well. He thanked the teachers. He said nothing about Ant Group, nothing about the IPO, nothing about the speech. The video was uploaded. Within hours, it was difficult to find. The consequences arrived in waves, and they arrived fast. On December 24, 2020, China's State Administration for Market Regulation opens a formal antitrust investigation into Alibaba, not the financial company, but the e-commerce empire. The investigation focuses on a practice Alibaba had enforced for years, requiring merchants to choose Alibaba's platforms exclusively, threatening to pull services from any seller who also listed on a competitor. In April 2021, the fine arrives. 18.28 billion yuan, approximately $2.8 billion US dollars. The largest antitrust fine in Chinese history. The basis, 4% of Alibaba's 2019 domestic revenue. Simultaneously, Ant Group is ordered to restructure as a financial holding company under direct supervision of the People's Bank of China. The micro-lending operations, the credit scoring models, the asset management products, all of it brought inside the regulated system. Capital requirements are imposed. The freewheeling structure is closed. Ant's implied valuation falls from $316 billion at its planned IPO to somewhere between $78 and $104 billion by 2023. It never lists. When China completes its investigation of Ant Group in 2023, it issues a final fine of approximately $1 billion US dollars and declares the rectification complete. The entire crackdown on the company that was supposed to be worth $316 billion ends with a single statement and a billion-dollar bill. Alibaba's market cap, meanwhile, falls from its peak of over $600 billion in late 2020 to below $180 billion by the end of 2022. One of the largest destructions of publicly held shareholder value in corporate history, compressed into approximately 18 months. Here is the acidic beat. Alipay still lives on 1 billion phones. The app still works. You can still buy a cup of coffee, split a bill, pay your electricity. But the version that existed on October 24th, 2020, the one that moved money outside the state banking system, that extended credit on proprietary algorithms the central bank did not control, that knew more about how 1 billion Chinese people spent money than the People's Bank of China did. That version was not destroyed by the market. It was not killed by competition. It was unwound by a regulatory order that no court reviewed and no shareholder approved. The crackdown spread. Didi listed on the New York Stock Exchange on June 30th, 2021. 2 days later, China's internet regulator ordered Didi's app removed from all Chinese app stores on national security grounds. The following year, Didi was fined over $1 billion. Tencent, Meituan, and dozens of other internet companies faced investigations, fines, and forced restructuring. Tens of thousands of technology sector jobs were cut across the industry. By some estimates, more than $1 trillion of market value evaporated from China's technology sector. By 2023, Jack Ma is back. He travels to China. Alibaba restructures into 6 business units. Beijing declares the crackdown over. Ma reappears at conferences. The party announces that the creative economy needs entrepreneurs. Everyone is meant to move on. It is tempting to read all of this as a story about overreach. A billionaire who forgot his place and was reminded of it. That reading is too easy and too comfortable. What actually happened is simpler and stranger. Jack Ma did not say anything false in that speech. He did not do anything illegal by the standards of any economy that calls itself free. He criticized a banking system that is, by most measures, genuinely behind the times. He built a financial product that genuinely served people the state banks had abandoned. He was, by most assessments, right. What he forgot, or what he revealed that he had always known but chose to say anyway, is this. In China, being right is not the protection it appears to be. The permission to succeed has always come with a condition. The condition is never written down. You find out what it was when you violate it. The speech did not cost him $34.5 billion. It revealed that it was never really his to keep.